we're going to go ahead and get started. As you can see, this is the What's Your Startup Worth session. So if that's not where you want to be, then feel free to leave now. Without further ado, I'm going to go ahead and pass it off here to Patrick Meenan, who's our presenter today. If you can give him a warm welcome, that would be appreciated.
Hey, cool. Good afternoon, everyone, and thanks for taking time out today to come hang out with me for a little bit. I've been warned by many people that we've got technical difficulties with the cord and it goes out a lot. So if it does go out, we'll be prepared with a little whiteboard here to kind of ad-lib it. And then Andy put a link with mediocre, like 6 out of 10 handwriting, for that will have a link to the deck if you want to download it or just follow along. No big deal at all. So today's talk is What's Your Startup Worth? And some of you may have attended last year when we did a similar sort of session. But the goal for today is to have a no bullshit, open and transparent conversation about a topic that I personally think is annoyingly secretive in startup land, which is valuations. And specifically, we're going to talk about that at the seed and Series A stage. So it's still relatively early. And we're going to do a handful of things here. I'm going to give you a little bit of context on where I'm coming from, because context always matters when you're getting any sort of advice. We're also going to look through stats within our portfolio. So went in and actually aggregated statistics within companies that we've actually funded that will hopefully provide a little bit of a quality guideline for you guys in case you are interested in applying that to your own business. From those stats, we're going to pull out a few key observations that we're going to talk about. And then most importantly, we're going to give advice on how to set your own expectations if you're going to be valuing your startup. And we're going to do an actual illustration of implications if you want to do like a $5 million round. And then we're going to talk about how to handle valuation with investors, which is a nerve-wracking topic for a lot of people. So that's a lot to cover, but we're going to go super fast. And I'm hoping we can get through it in like 20, 25 minutes and answer a lot of questions, because last year there was a lot of really high-quality questions that came out. And the reason I personally wanted to do this session is I think that off-market valuation expectations, at least for us and many other investors, kills rounds before they even start, and it's really unfortunate. A lot of times entrepreneurs do a lot of really good stuff building their business. It's hard as hell, and it's a real shame when they just can't get a fundraising round done because they're just not educated, because they don't have access to quality data. So part of what we're trying to do at Arthur Ventures here today is give you guys access to quality data that hopefully can guide you in what you are out doing in terms of your company and valuing it. So a little bit of context on where I'm coming from. I'm a partner with Arthur Ventures, and we are a national investment platform for the fastest growing SaaS businesses anywhere outside of San Francisco. So we're incredibly thematic about not investing in the Bay Area, but we are not thematic about any one geography outside of there. And we're based right here in Minneapolis, and we have some folks in Fargo, North Dakota as well. So a few things about Arthur Ventures that I tell our investors when we're pitching, because believe it or not, venture funds have to raise money too, so we have to feel the pain. First, we have capital. So our first fund was raised in May of 2013. It was a $45 million fund that was deployed into 20 companies. The last new investment out of that fund happened in December of 2016. Then in January of 2017, we closed our second fund. We did a first close of $43 million. The fund's going to be 50. The reason for the gap in time is we just have a few folks that we're working through legal documents with. So it's going to be a $50 million fund, and the strategy is going to be exactly the same, which is really nice. Second is that we're active. So we have invested every single quarter since May of 2013 when we raised that first fund. And across those 20 companies, all of that money, we have participated in 37 total transactions. So the reason the numbers aren't the same is that oftentimes one company raises more than one round, and we participate in a lot of follow-on rounds. The other thing is that we're early. And so at Arthur Ventures, what we do is we make initial investments, typically of $1 to $3 million, in rounds of 1 to 5. And so we don't really know what that means, whether that's seed or whether that's Series A. And quite frankly, we don't really think about it. To us, it's just you're investing $1 to $3 million in rounds of 1 to 5. And that means that you are an early stage investor. Cool. I actually feel good about this because they told me it wasn't going to work. And so, like I said, we got the whiteboard. We're going to make this work. And then also, please check out the link at the bottom of that whiteboard if you want to follow along. So like I said before, we are also national. And so we have investments in Seattle, LA, Phoenix, Dallas, Atlanta, Baltimore, New York, Pittsburgh, Philly. I mean, you get the idea. When we say we're national, we are very seriously national about what we do. And then the other thing is that we have broad reach. So our fund analyzes about 6,000 companies per year. That doesn't mean that they're all emailing us, but we are actually doing work to go out and find companies and see if those are a fit for what we're doing. And then the last thing is that we're focused. So everything that we do from an investment standpoint is B2B. So we're not doing any B2C. We're not doing any, so like don't talk to me about daily active users. We don't do a lot of large IP stuff. And so we are not a great firm to talk about the value of IP protection. And so I'm going to pull this up on my phone real quick because I'm going to make this chart here. So I'm going to go ahead and just write out our stats. And this is all going to be available on the presentation that Andy linked out. So our seed investments that we've made 7 seed investments to date. The average pre-money valuation was $5.2 million. The average round size was $1.2 million. We're going to walk through what all this stuff means, which means the post is 6.7. Investors took about 19% of the company. And then the ARR was about 400K. And we don't really look at month-over-month growth rate. For Series A, we had 12 investments. That provides data in the deck. The average pre-money, and we're going to go through all of these in a lot of detail, so don't worry about writing these down, was 12.5. The raise was 3.7. And the post was 15.2. This will all make sense in a second. For 24% ownership, they had about 1.6 million of revenue, growing 15% month over month. So we're just going to look at this data and draw a few conclusions from this. So the first thing that sticks out to me when we look at this data is the amount of traction at the seed level is really surprising to me. So a lot of times when we share this data, people say, $5.2 million pre-money for a seed round sounds pretty good. But the key thing that I look at is that those businesses had about 400K of annual recurring revenue. So what that means to me, the actual observation is the amount of seed traction. The implication from that is that if you have a startup and you are pre-revenue, it is probably a good idea for your valuation to be below $5 million. But believe it or not, a lot of people don't do that. So what you're trying to avoid here, and the avoidable mistake, is to come in and try to raise the $10 million pre-money seed round. And quite frankly, it happens all the time. It absolutely happens all the time. And that's one thing where an investor might look at that and just say, no way in hell, we're not going to do it. And a lot of folks mess this up because their startup is their baby. They put a lot of time into it. They think it's incredibly valuable, and it is. But this is just a really, really good barometer. So when I meet an entrepreneur and they say, we're going to raise a seed round, we're pre-money, I usually view it as something that's probably going to be at a pre-money between 2 and 4. And if they say it's below 2, I think, you know what, that's probably a little bit more than you have to do. You can raise the valuation. If it's more than 4, I think that it's actually a little bit expensively priced unless there is traction. And one thing I should have done before we actually went through the observations is just to do a recap of the math here. So the way this works for those that aren't familiar is you've got your pre-money valuation, which is what people talk a lot about when they're valuing their startup. What you do is you add to that the raise amount to get to the post money. So that's why the 5.2 pre plus 1.2 equals 6.7. The investor ownership piece is what people mess up all the time. It's the amount of capital you raise divided by the post money. So that 19% should equal 1.2 divided by 6.7. So I want to make sure I'm not talking past people there. So the second thing that I found very interesting when I was looking at this data is that the average investor ownership in either round was about 20 to 25%. And quite frankly, the broad parameter is that in any one round, an investor's probably going to want to own 20 to 30% of a business. And so the implication of this is that investor goals matter too. You have to keep in mind what is in it for the investor. And the reason this matters, because a lot of people think that, VC's target ownership percentage is bullshit, like it's not my problem, I don't have to deal with it, that's their problem. The reason this matters is that, take us for example, our fund, let's just say it's a $50 million fund. For us to actually be well regarded in the eyes of investors, we have to roughly turn that 50 into 150. Okay, it's pretty hard to do. So let's say we make an investment in a company and we own 10%. We put in $1 million for 10% of the business. And that business turns out to 20x, we've returned like $20 million, right? So if they sell for $200 million, which is a huge deal, we return 20. Well, we still have a hell of a long ways to go to get to 150, right? Whereas if we actually own 25% of that business and it's sold for 200 million, it's like 50 million bucks. It's a whole nother game. So that's the reason that matters. And so go ahead. No, total round. Total round. Great question. That's the total round. And the implication or the avoidable mistake on the ownership piece, and this is the thing I see people do all the time and it's really painful, is someone trying to raise 500K at 10 pre. Right? Basically, the investor is going to own less than 5%. I see it all the time. Or sometimes I'll see a business that's doing well, and they'll say, we want to raise $2 million at 50 pre. And like that deal doesn't even exist. Okay, just no firm's going to do it. And so it's just really important to actually think about is what would the investors own in a business? And we'll walk through this in a little bit more of a decision tree in a minute. The third observation to me, and I also want to know if there are other observations from you guys looking at the data, is the actual amount of annual recurring revenue that happens in Series A investments. So in this case, the Series A companies, the 12 investments that happened that were clean Series A rounds, had on average about $1.6 million of annual recurring revenue. So it's probably like $133,000 a month or something like that. So the reason this is so important is that a lot of times people try to raise Series A for reasons other than traction. They'll say, we feel the market is huge, and we feel like the market is happening right now, so we have to go. We believe that we've developed all this IP and we put so much value into the product that we're totally Series A ready. And what happens is they go out and they try to raise, $4 million with like $200,000 in revenue, and it just doesn't happen. And so that's one of probably the biggest metrics that we feel like people don't realize is that when you read about these headlines of companies that are raising Series A's, they've got good teams, they've got good markets, but they've also built a pretty solid business, and that's why it's so damn hard to actually go out and do that. Yeah.
Why isn't the margin
In terms of actual gross margin and stuff like that? Mainly because we're only investing in SaaS, and so I'm just assuming that it's strong. And so it depends on various type of business. But yeah, if you have a lower gross margin business, like a services business or something like that, it would trade at a lower multiple. So the last one, and then we're going to move into actually how to make decisions, is the relationship here between multiple and growth. So I didn't write it on here, but whenever investors look at a valuation multiple, they do it on the pre-money of an investment. And so in this case, the pre-money of $12.5 million with a revenue amount of about 1.6, this is about an 8x multiple of your revenue. It's a pretty strong multiple. The actual ranges that we see are anywhere from like 8 to 12x. Now the key here is that these businesses were growing roughly 15% month over month at the time. So it's truly exceptional growth. And the reason this 15% marker, you hear a lot of people talk about, they say you have to be growing 10 to 15% month over month. The reason that is that basically means that your business is on pace to double or triple in a year. That's why people back into about 10 to 15% month over month. And so what a lot of people don't realize, and I think this is probably the number one thing that entrepreneurs get wrong when they're going out to raise, is this relationship between multiple and growth. And so the avoidable mistake that you can make is a lot of entrepreneurs will come and say, I'm going to raise, $5 million bucks, and I've got $1 million of revenue, and I'm going to go get that deal done at 10 pre, even though they're growing at 30% year over year. And so it's very difficult. So it's really important to keep in mind that the only way that you're going to get valued at a high multiple is if you're growing fast. And so a lot of times we'll see founders just think, I am of a certain amount of revenue, therefore I am worth 10 times my revenue. And that's really not the case. It really is how fast is that revenue growing. And so those are the 4 key things that popped out to me when I was actually looking at the data. And so what would actually be helpful now is to go about how do you, yeah, go ahead.
So this is for B2B. For B2C, do you say the same article?
I can't even give guidance on it, to be honest. I think that's why I don't do that stuff. I mess it up too easy. But no, there's a lot of smart investors out there who invest in B2C. Oftentimes, there's less revenue. It's more of a daily active users or some actually activity metric. But yeah, this is only B2B stuff. So if you're looking at like consumer or you're looking at marketplaces or something like that, there's a lot of smarter people than me that know how to do that stuff. And so in terms of going out and actually setting your expectations on your own raise, If I were going about trying to do this myself as an entrepreneur, I would look at 5 things in order to actually go out and price my round. The first thing I would do is I would go out and I would determine how much cash do I need to hit my near-term milestones. A lot of founders do this right. They'll say, I need to hit these revenue targets, I need to hire these people, therefore I need to raise $2 million or $3 million or $5 million. The next thing I would do is based off that valuation amount, we're gonna walk through an example here. I would actually take that amount of money and I would divide it by the amount of ownership an investor wants to have, call it 25%, and I would come up with the valuation for my business, okay? After I have a valuation for my business, all I would do is I would sense check that with my own traction of my business, then also my growth rate. So we're gonna walk through a decision tree real quick on how to do that. Then the last thing I would do is I would get advice from other entrepreneurs that have raised money. A lot of the great entrepreneurs in this city are happy to talk to you. You're more than welcome to email us, and we're happy to give some sort of guidance on like, yes, this smells right, no, it doesn't. It's kind of hard to do when you don't know someone that well, but it's something you can get pretty easy data on. Does anyone have like a Kleenex or something to wipe off the whiteboard? You know what, I actually, my bag. Sweet. Thank you, thank you. Okay, cool. So what we're gonna do is we're gonna do an illustration on probably the most common round that we see, which is I'm gonna raise 5. Entrepreneurs always say this, I'm gonna raise $5 million for my business because I just have to. And so, they do, it happens all the time. And so the first thing we're gonna do is, what was on our little 5-step process here, the first thing that we're gonna do is we're gonna determine the raise amount. So the first thing we do, raise amount was $5 million. The second thing we're gonna do is we're gonna determine what that means from a valuation standpoint based off ownership thresholds. So for the second step, what we're gonna do is we're gonna say, on average, we said investors wanna own 20 to 30% of a business. Let's go ahead and say, you know, they wanna own 20 to 25% of my business. The third thing we're gonna do is we're gonna actually determine the valuation for that. And so, and this is what I had said before, there's a little trick on how to get to the valuation math. First, you get to the post-money valuation, which is how we determine how much the investor owns. So we're gonna do 5 million, and we're gonna divide by each one of these ownership percentages. All right, so this basically means that an investor is gonna own, you know, what's 5 divided by 25, 20? Someone's here smarter than me, right? All right, so we're gonna go 20, be 20 post, minus the raise amount is 15 pre. We're gonna make this 25 to 30%. So that means that the pre-money valuation would need to be $12 to $15 million for that round. Because what we do is that would be pre-money is 12, post-money is 17 and 20. The way we get the math, 5 divided by 20, 5 divided by 17. So when someone tells me I'm gonna raise $5 million, the first thing that pops in my head is this is a business that wants to be valued at 12 to 15 pre, okay? The next thing I'm gonna do is I'm gonna say, what's the traction of that business? Based off the multiples that we were talking about before and what companies usually have when they raise a Series A, my first question to the entrepreneur is gonna be, do you have 1.5 million-ish in annual recurring revenue? If they say yes, what I'm gonna do is I'm gonna ask them about their growth. Okay, so we'll do yes, no. I'm gonna ask them how fast they're growing. I'm gonna say, are you growing 10 to 15% month over month? And if they say yes, growth 15. If they say yes, we're gonna say we're good. I'm gonna explain these in a minute. So we're just gonna walk through the tree real quick. Someone comes to me, I'm gonna raise $5 million. I think the investors are going to want to own 25 to 30%. So I think that business is going to raise at 12 to 15 pre. I ask them, do you have 1.5 million of revenue? And they say, yep, you know what, I do. Because I think that's the minimum viable traction amount to raise a Series A. The next thing I ask is, what's your growth? Are you growing 10 to 15% month over month? And if they say, yep, I am, I say you're good to go. You've got the traction amount right. You've got the growth amount right. You're absolutely ready to rock. If they come through and they say, you know what, I do have 1.5 million of revenue, but I'm not growing 15% month over month, I'm a little bit of a slower growth business, the first thing I say to the entrepreneur is, you might be able to raise $5 million, but you might not be able to raise it at those valuations, because those valuations command premium growth. Someone might come in and give you $5 million, but it might be a little bit more dilutive to you, so just keep that in mind. Maybe you should actually pull your valuation down a little bit, or at least be prepared for that to happen. Going to the flip side here, when I ask the person they have 1.5 million of revenue, they say, I do not. Next thing I ask is, are you growing 10 to 15% month over month? If they don't have that revenue amount, but they are growing really, really fast, they might be able to go get that round done if there's some sort of special condition that exists. Either the market is super hot or the team is absolutely really senior. They still have a shot at that potentially happening. But if they're not, they don't have 1.5 million of revenue and they're not growing 10 to 15% month over month, there's no way the round gets done. It's just absolutely not going to happen. So on the deck link, it's going to be a much better diagram of how this all works, but it's the exact decision tree that I use with entrepreneurs when they raise. And the reason this matters is, again, this is what the investor's thinking about. And if they don't happen, they might just tell you something sort of bullshit on why they're passing, and that might not be telling you that your round's overpriced. They might just say, oh, we don't like the market, or now is not a good time. What they're probably thinking and not being very transparent about is the fact that the valuation of your round and what you're trying to get done is just way off. Yeah, go ahead.
How do you calculate the 1.5 million based on the raise? If the raise isn't different?
Say that again?
If the raise isn't 5.
Yeah, that's right. So I just used the example of raising $5 million, which was a Series A.
But is it like a 0.3? Is that what you're saying, 30%? Or is it not a linear relationship?
There's not a linear relationship. There's not a linear relationship. Exactly. Exactly. And it's not a perfect scale, but that's absolutely correct. And so the businesses that we funded that got valued at 10x, we're basically doubling or tripling year over year. And like at scale too. They're going from $1 million run rate to a $3 million run rate. Yeah, here, then we'll go back.
How do conditions in other markets impact your multiple inputs?
In terms of actually geography?
Well, just in terms of like, you look at the fact that kind of hyper-liquid conditions out west are you seeing huge capital deployment that's outstripping liquidities. Yep. Like, what does that do to your multiple then?
It's a really good question. And so it goes up, but it's for reasons that you wouldn't think. So to us, so we don't invest in San Francisco, but like frothy markets we do invest in, like Seattle and New York City. So in Seattle and New York, there's a lot more capital out there. And there's also a lot more national investor interest. So what we will see is investors willing to write a larger check initially. So whereas around here might be like $2 or $3 million, it might more easily be 5 to 7 in New York or Seattle. And so doing this ownership math again, if someone tells me they're going to raise $7 million, I automatically assume that the pre-money is going to be $20 million. Right? Because, or maybe 15 or something like that. They're not going to raise $7 million at 8 pre and give up half their company. Do you know what I'm saying? So a lot of times investors' minimum checks, like the investor who might give them that might be their minimum check, artificially push up valuations. Does that make sense? But it's never like, oh, this company's in Manhattan, so it's worth 13x. It's more of a function of ecosystem and amount of dollars that go in and how that actually impacts the prices of the rounds. But I would say that these numbers stay pretty consistent in markets that we've been in. Like we've invested in Seattle, these exact same rounds, New York, these exact same rounds. But it does get altered a little bit based off where you're at. Here then here.
Can you work the numbers backwards? Instead of saying I need 5 million and here's my 1.5 million revenue with 15% growth, if you say I've got 1.5 million with 15% growth, does that necessarily mean that 5 is where you ought to be?
Yeah, so oftentimes what the investors go want to hear is what do you actually need to grow your business? And so doing the backwards math isn't always the best check, but it's something that's good to do. But I think it's usually this way, and it's usually a dictator on if you can actually go raise capital or not. And so doing the formula back, it's okay, but what the investor is going to care the most about is the actual cash that you think you need to get your milestones completed. We're going to go here, then here.
Can you talk about the investment horizon that you're looking at, like in terms of exits and fresh
Yep,
exits?
exactly. So for, and I'll go into a little bit more detail than I did up front. So 80% of what we do is exactly what I've been talking about, which is Series A. And then part of, is this up too?
No, I'm rebooting it, go ahead.
I was gonna say this fucking apocalypse. so the 20% of what we do is we participate in later rounds in companies. And we do that as a whole portfolio theory of our fund because we want near-term liquidity. So for the 80% that we normally do, that's seed and Series A, our total hold of our fund is 10 years. We often think that anywhere between 5 and 10 years is when we can expect to experience liquidity, with the average being like 7-ish years. Does that make sense? And on the later rounds, it's more of a 3 to 5 year hold.
So the exit would be for you a Series A or Series B?
Oh no, so we hardly ever come out in those sorts of rounds. So for us, the exit is almost always acquisition of the company or an initial public offering. Sometimes if you have a company that is, raising hundreds of millions of dollars size rounds, you can get out in those, but we haven't done that today. We actually follow on pretty aggressively. So like companies here, When I Work, we've invested 3 times, Lead Pages, we've invested 3 times. So when a company is performing really well, we'll absolutely go and put more capital in. But the thought process is different, right? Like if you're investing in a company at $100 million pre-money, you don't necessarily think that's going to be a 10xer, right? So your Series A at 10 pre might be a 10xer, 20xer. When you get to 100 pre, you might be thinking, this is probably like a 3 or 4x I can expect out of this investment. But usually you're okay with that because the company might have, 12, 14, $15 million of revenue. You feel more comfortable about that.
Thanks.
Cool. And then the last thing I just want to do, and then I can open up to more questions, is give advice on how to handle the conversation with VCs. So this is an area where I find founders kind of freeze, and I think it's rightfully so. What I would avoid doing is getting into math camp. So while I hope some of this stuff, my artful handwriting here, was really helpful, I would not walk through a decision tree like this with an investor, because you're just going to start nitpicking on little points. Okay. Instead, what I would do is I would say, let's say you're going to raise $3 million. I would say, I've determined that my business needs $3 million to hit our key milestones and get to where we want to go. I understand the amount of ownership investors typically want for a round of that size, and I expect to be within that range for valuations. Okay? And then I'm going to let the market decide where I'm at. So in this example where I said if someone's raising $5 million, I assume that they want to be valued between 12 and 15. If someone would have told me what I just told you, I would have thought, okay, this entrepreneur wants to be valued between 12 and 15. And what it does is it cuts out some of the miscommunication of them being like, well, actually, I was thinking 50. It just cuts all that down, and you're able to signal to an investor that you roughly understand how valuations work. Like, you get it. You're not going to be unreasonable. You're not going to get taken advantage of, but you're really going to let the investor dictate exactly where you fall out. Like, if you use that line, you are just set up golden for any valuation conversation with an investor. If you're dealing with angels or someone who is less active within the tech investing scene, I wouldn't do the decision tree. I would just walk them through some of the logic that I talked about, which was, this is my traction, this is my revenue growth, and therefore I want to be valued at 7x my revenue. And you actually have to hold their hand a little bit on why that is the case, and hopefully that the deck that you can download will help guide you through that a little bit. But that's exactly what I would do.
So when you're coming out with growth rates, do you see past history to support that data? Or
Yep.
how far back do you have to go?
Absolutely. So it depends. So now we're really talking Series A, because at seed it's just different, right? There's no real multiples. I mentioned the companies have traction, but you can grow 10% month over month at $20K in monthly revenue, and you're literally adding $2K a month, right? So I love the pitch decks when it's we grew 8,000% last year. So typically you do for Series A have historical data. If you're growing really fast, it might just be 1 year. But you're able to see this is what they've done, because no one's going to care what you think you're going to do, right? They're going to want to know what you've actually done. And so any Series A that we've done, entrepreneurs have been able to show, even if it's their cash collections, just an Excel spreadsheet that just says, this is what I've been doing for the last 12 months, and this is why I think I'm going to do it for the next 18 months, is all they really want to see. So anyways, that's all I had for my jangled content on how to actually price your startup and walk through the valuation conversation with VCs and other investors. I'm happy to answer any other questions that folks have. Good.
Yeah, so when somebody comes to you and says, I'm raising $5 million, I assume one of your first questions is, great, how are you going to deploy that? What's it for? what do you want to hear in that case?
Yeah, and we're a little bit of an exception. I actually don't care. It's less about what you're going to do with it, quite frankly, and more just, why is it a great place to put our money? Do you know what I mean? Like, Clay's talked about this publicly all the time, but they didn't spend any of their VC till they were like 17 or 18 million in revenue or something like that. And so I actually don't care what the use of proceeds is. Usually the stronger the use of proceeds, the more the company needs the money. Do you know what I mean? They're like, hey, I'm totally out of money and I need to go make these hires. It's a little bit more fun when they're like, yeah, I'm kind of profitable, in and out, depends on the month. And I want to raise this much money because I want to make a bunch of hires in these areas. I don't know how much of this money I'm going to spend, but it's not going to be all of it. But things are just going really well, and I want to put some fuel on the fire. And again, we're a little bit unique in that sense, but.
Second question is, how does your return targeting influence your round participation?
In terms of later rounds?
Well, in terms of $5 million, if target ownership on that is 30%.
Yeah.
Yeah. Are you the exclusive participant in that round?
That's a great question. So on rounds that are 3 and less, we are typically like 75% or more of the capital. We're more than happy to do a full round by ourselves. So if anyone's heard the Ionic framework out of Madison, we did the $1 million seed round by ourselves. And that was totally fine. What we're oftentimes looking for in rounds is we want to own 10% ourselves. So here it was the investor ownership of the entire round, right? Someone owned actually 25%. We as a fund are typically targeting 10% ownership, and we're only investing in 20 companies, which, believe it or not, is actually concentrated to most funds of our size. And so we want to put in as much money as we can. We'll never have a position that's more than 10% of our fund. So no one company has more than like $4 million of our dollars. But one thing we'll never do just as a fund is that we're never putting in like $250K in a $5 million round. It just doesn't make any sense. You don't own enough. And to the point on the ownership and how it impacts your fund returns. That's why we don't do it. So we're typically as much as we can be. But if someone raises $10 million, we're probably like 2.5. Yeah.
Can we get away from the money stuff for a minute? When someone's coming to you to ask you though about that they want to know if you can literally investing in them, I'm sure you could do horror stories that might be more fun of the stupid things people have said. Like how do you know this is someone you want to invest in? Like character, their personality, the team. Can you talk more about the non-map money stuff?
Yeah, sure. Well, on the first one, and I really genuinely mean this, I don't think we've ever laughed at an entrepreneur. I don't think we've ever talked about, oh my God, I can't believe they did that. We just think there's a lack of education on stuff. So oftentimes, quite frankly, we feel bad because it's just an honest mistake and they're too busy building their business, right, to actually have to think about this stuff. But in terms of what we look for, it's a lot of different things. So we are not thematic within SaaS. Really? So like I say this a lot, but when we invested in When I Work, I didn't have like an hourly scheduling thesis. And there just happened to be a company in St. Paul. It was more just that we met a fantastic entrepreneur in a great company that was building a great business in hourly employee scheduling. So for us, we always want to see a growth story. We always want to be funding momentum. We believe that we can't pick markets and we can't fix customer problems. So in almost every investment we've made, an entrepreneur has clearly communicated to us why everything is going really, really well right now and why they think it will continue to go well. In terms of the actual founders, we tend to gravitate more towards product-driven founders. It doesn't mean you can't be. They're not all that way. Like Joe Whaley with Total Expert is certainly not a product founder, whereas like Clay or Chad or somebody gravitates that way more. And so for us, we fund a lot of first-time founders. They don't have to be super polished in raising money, anything like that. The number one thing we probably look for is a bigger vision, even if it's one that we don't quite understand. We're not just a landing page business. We're going to build this marketplace, and we're going to buy a marketing automation company, and we're going to build this actual open marketing automation platform. Or for When I Work, we're going to get all this data on hourly employees, and we're going to be this hub for them, before the job, on the job, after the job. And there's got to just be some vision there, because what we really look towards as investors is, this is a business with $1 million in revenue. Can we see it being a $25-50 million business just doing what they're doing today? Then there's this kind of like moonshot upside potential where the take over the world scenario happens and they actually reach a really, really material amount of scale, and there's kind of that upside that's there. So those are kind of 3 things that we usually look at. Yeah, we're gonna go back on here, so we'll start there.
So say the investor ready, right? We come with an idea. Well, what if it's not like product service like marketplace? Like what if it's something like, the system hasn't been invented yet? So someone's listening out.
So then that's typically like a pre-seed sort of round. So unfortunately, all this nomenclature stuff is really frustrating. If it's truly a business that is like ground level, doesn't really exist yet, truly an idea, typically in terms of like valuation metrics, it's going to be much lower. Those companies are usually priced in the 1 to 2 range. And then usually the capital is going to come from individuals or those that know you really, really well. Does that make sense? Because at that stage, the biggest risk is character risk and who the person is. And usually those people know you really, really well who are going to invest that money. But those rounds very rarely get done by an actual venture fund unless they know you exceptionally well from a prior company. Does that make sense?
It's a little bit of, the question is a little bit of like founder advice.
Yeah.
So as you know, I'm like 1 month in and I'm literally looking at this year as product market fit, test and learn. But there's something in the back of my mind that's always like, oh wow, I really got to hit these metrics and get to that growth again. And my question was more around how far back do you look when you're looking at traction to say, all right, like they took the first year or whatnot, and there were a lot of blips because they were like hit it firing and it was like a miss. And essentially, how do you kind of evaluate that? Is it okay, they reached a point in year 2 and then they've been constant, or is that actually a penalty in terms of evaluation?
Yeah, so I would say the momentum, the recent momentum matters. So you always want to invest in something that's recently growing. But I think the number one advice to entrepreneurs is just patience is a virtue. And this stuff takes a really long time. So you always think about people just start businesses, they go raise funding really fast, and it's just not the way it happened. I know I keep using local examples, but I just think it's helpful since everyone's from Minnesota here probably. So like when I work, it took them 3 years to get to $30,000 in monthly recurring revenue. 3 years, like that's like not good at all. I mean, they did a lot of cool stuff during that time, but no one's going to get excited about that. When they went from like $30,000 a month in revenue to like 90 in like 8 months, I think. And so clearly they figured something out. So it's kind of like, yeah, we were figuring it out. We're building product. We're going. Then it was like, holy shit, this is really working. And then no one cared about like 3 years ago. You know, all anyone saw was like the last 9 months. Do you know what I mean? So I think it's way more important to actually take your time and get it right. Because the worst thing to do in any of your businesses is raise money too early, spend it, and then just let that ruin your company. You know? And then you had your hand up, right?
Let's go back in history a little bit.
Yep.
Bid coup.
Yeah.
Super high, Series
Yep.
A. Did that fit into your decision?
I excluded it. And so the reason I excluded it was I think it's a pretty abnormal scenario of
Is that the moonshot scenario?
I think it's less that, and it's more whenever you have really experienced teams, which quite frankly was Phil in that case, weird shit happens. You know, like there's no like, I wish there was like an eloquent way to describe it, but you see it in all sorts of markets where people go out and they raise huge rounds. What I will say is in rounds like that, oftentimes the entrepreneurs are giving up like half the company. Does that make sense? So when you see those huge seed rounds where someone raises $15, $20 million, that doesn't mean the round was priced at like $100 million, right? It typically means that they're taking a lot of dilution right out of the gates. Does that make sense?
Yeah, I guess it makes sense to a degree, I think, based on the founder's experience, but since 90% fail, I'm not sure how accurate of a measure that is.
Exactly. So maybe it wasn't a good round, right? Just because they raise a lot doesn't mean it's good. You know what I mean?
So there's been quite a bit of hate lately towards safes and convertible notes. Can you talk a bit about your thoughts on when a company comes to you for a series round, for a seed round, how do you like to see them structured? Do you care if it was a priced round beforehand or if it's coming in the form of...
Yeah, awesome question, Zach. I personally really prefer priced series seed rounds. I think that it's a total myth that they're more expensive. Oftentimes they can be done for like $5,000 to $8,000. The reason I like them just because it's more, I think it's just cleaner to price the company. I also think it's in the founder's best interest. So a lot of times, and there's been a lot of really good stuff written about this. Fred Wilson specifically had a great back and forth on this on his AVC blog. It's in the founder's best interest as well, because obviously, as many of you probably know, with convertible notes or safes, the way they're structured is that you'll say, we'll just use convertible notes, for example. It's going to convert at a $5 million valuation if I raise my next round higher than $5 million. So like if I raise my Series A at 10, good for you, you convert at 5, everything's awesome. But if things don't go well and I raise it 2, all that money ratchets down to $2 million. So it can be very, very dilutive. We've invested in both. So we've invested in 2 safes. One has since converted to preferred stock in an A, and one is still outstanding. I think we've done one convertible note initially. We don't really care. We're not going to let the structure get in the way, but we prefer a price round just because it's easier. On a safe or a note, when we are more open to doing that, it's truly when it's a very like early stage product company. It's pretty binary on if it's going to work or not. And we're like, you know what, we're either going to totally lose our money here pretty fast, or it's going to be fantastic. And the entrepreneur is like, I don't even want any distraction. We'll do it. So I guess 3 companies out of 20, the first investment was in one of those vehicles, a safer note.
And as a follow-up, is it a deal breaker if that note is going to convert into the same class of securities that you're going to buy in your round?
Oh, like if I'm doing the A and there's notes out there?
Yeah, and those notes are set up to convert into an equity that the VC is going to buy.
I think it's fine. So just to make sure I understand, like, I'm okay if I'm doing a Series A round if there's a bunch of seed money that's in notes? Is that the question?
Well, no, he's asking if he's going to convert it to your round preferred.
Yeah, I don't care. That's the way it oftentimes is. So my understanding when I see notes out there, the most common form is that it's going to be the same security, which is it's going to be the same preferred security, but it's going to be at a different price because of what they negotiated. And that's standard stuff. That's not a big deal at all.
And then if I can ask one
Yeah,
last
it's
question.
fine. We got
On
time.
liquidation preference, can
Yep.
you just talk a bit about that? Because I think that's something that founders especially don't know enough about, and what is market in your opinion?
Yeah, absolutely. So what is market for sure is a 1x convertible preferred security. So we'll do this fast. There's 2 things that matter with preferences. One is the actual multiple, which is almost always 1. So what that means is that if I give you $1 million, my preference, if it's a 1x, is $1 million. If it's 2x, it's $2 million. Complicated stuff. You guys can do the math. It's very rarely I see anything other than a 1x. The second thing is whether that preference is convertible or participating. And so what happens in convertible is, let's say I put in $1 million for 10%. Upon a liquidity event, I have to choose between the better of $1 million or 10%. So if I give you $1 million for 10% and the company sells for $200 million, I'm clearly taking $20 million over 1. I'm going to convert it into equity and it's all good. If your company sells for $3 million, clearly I'm going to choose $1 million over $300,000. So you have to make that yes/no choice. When it's participating, the investor gets 2 bites at the apple. They get the first $1 million out of the proceeds and they get the ownership. So in the case I gave of a $200 million exit, I would get $1 million. That means there's 199 to distribute to everyone, and then I would get 10% of the 199. Okay, that really matters on lower price rounds, because the example I gave of the $3 million round, or the $3 million exit, I would get $1 million, and then I would get 10% of the remaining $2 million. Participating sucks, total bullshit. Always do 1x convertible preferred, and it's totally standard. Every single deal that we've ever done has been that. Answer your question?
What's your success on the flop rate percent in your portfolio?
Yep, so our targeted loss ratio is anywhere between 20 and 25%. And for us, that portfolio is still maturing. So we are about 3.5 years, almost 4 years actually, into the fund. And so we're just now starting to see, who's going to be great, who's going to fail. And we expect it to be around 20 to 25%. Oftentimes what you'll hear is like a commonplace in VC is that you're going to have a third of the companies do really well, you're going to have a third of them get your money back, and a third of them are going to fail. Our ratio is a little bit different because we're investing only in SaaS, which is revenue producing, and we're typically investing post-revenue. I would if the hardware was like less than 20%. So there are a lot of businesses that have a very, the hardware component makes sense. There's a lot of like remote monitoring companies that have like hardware tags and software, and the tags are like a very small piece. I think that's fine. But if it's like an ag business where like, sticking something in the, the piece of machinery to get the data is like 2/3 of the revenue, it's just a different market. Correct. Yeah, it would be based on revenue. And also you can show the trend over time. So in a lot of those businesses, the price of hardware goes down over time, therefore the hardware revenue goes down over time. So it might be like a 30-70 split today, but you can actually draw a line to like, hey, it's going to be 85-15 in a few years.
I'm curious, how do the multipliers, you said it's a sliding scale between your ask and then the annual recurring revenue and
And the growth?
well, how does that change? Let's say you double to 10.
Yep.
What's the multiplier? As far as, okay, what does that mean in the recurring revenue?
If you double the 10, like your revenue doubles?
Yeah. No, like you're asking for $10 million, how would that affect the growth rate and the recurring revenue?
Oh, so it totally depends, right? So you could have a $10 million valuation on a business that has $4 million of actual revenue that's growing 25% a year. Or you could have a $10 million valuation on a business with $1 million of revenue that's tripling every year. Do you know what I mean? So it's like so hard to give a generic thing. I'd be happy to kick emails back and forth if there's like a specific example. But yeah, it's really hard to just give wide-ranging feedback on it. Exactly. So like, for example, there are funds that we are complementary with that have very different strategies than us. So they'll be out there and they'll say, we want to invest $5 million, but we want to own half of a company. So their ideal profile is not a business that's tripling year over year, right? Because $5 million is going to get them 25%. They're out there looking for businesses that are like $5 million in revenue, but growing 20 to 25% a year, where they can put in $5 million and own half the damn thing. Do you know what I mean? So it really, like, it depends on the investor, it depends on your business, it depends on your growth. It's a lot of different things come together. Yeah.
What does your decision tree look like pre-revenue?
Oh, so that's what we were kind of talking about before. When you're pre-revenue, it's just very much about like the base round size. So typically no business is ever valued below $1 million, right? So it's like typically like a $1 to $2 million round. You might be raising 250 to 500K, and the question is just, can you get someone to invest in you? Like, can you get it done? Right. So this is a better example for a company that's raising $5 million post revenue and all of that. And then we got a wrap. You can find me anytime, patrick@arthurventures.com, at Twitter, at PMeanin1. And thanks for joining and putting up with the tech. Appreciate it.